Welcome to Chanakya Capital. Today we're going to be discussing 5 private equity interview case studies. And case study number 1, let's move on to that. Let's understand the question first. A company with a PE of 12x is acquiring a company trading at 10x in a 100% stock deal. At what premium to the current price would the deal be a break even EPS neutral? So they are asking what will be the premium to this EPS neutral deal. So before moving on, let us understand what does this premium means. So in simple terms, you can read here, a stock premium is an extra amount you pay above a stock's basic or par or face value. This question is very common that I have heard that most candidates immediately say the deal is assertive because 10x is cheaper than 12x. You have to tell whether it is dilutive or assertive beforehand. But it is not always true. What actually matters is the purchase PE, not the trading PE, if you understand it very carefully. If the acquirer pays too big a premium, the deal becomes neutral or even dilutive. So to find out the break-even premium, we solve the price. How do we solve it? We have a formula for the break-even premium, that is acquirer PE divided by target PE minus 1. So acquirer PE is 12x that we read in our question, and our target PE is 10x. If we divide them and say minus 1, we get 20%. So your answer will be paying up to 20% premium keeps the deal EPS neutral, and paying more than 20% is EPS dilutive, and paying less than 20% is EPS assertive. Or you can answer them in a very common way, that is, to find out the break even premium, we solve the price. That would imply that 12x purchase PE, the same as the acquirer's multiple, and let's say the target earning is $1 per share and trades as $10, implying that 10x PE. Paying 12x means paying $12 per share. That is 20% premium to the current price. So the break even premium here is 20%. So you can use either of the answer as I told by firstly or secondly. Both are correct. Moving on to case study 2, this is very important. A company has a negative EBITDA, but it was just acquired at a premium valuation. How is that possible? So this is something that they are playing with your mind, and but it's very easy. Let's see the answer and you will understand it very awesome way. Yes, it happens and it is not as crazy as it sounds. Here's why. Valuation is based on future, not current EBITDA. EBITDA in is a point in time metric. Acquirers value the business on forward EBITDA, that is 2 to 5 years out. DC with a strong cash flow inflection path to profitability. If a company is temporarily making loss due to scale up, R&D, market expansion, current negative EBITDA is irrelevant to that. Secondly, we can say that EBITDA is negative due to intentional investment like common EBITDA negative drivers, heavy sales and marketing spends, R&D capitalization strategy, front loaded operation costs, underutilized capacity. Thirdly, we can also say accounting versus economic reality. EBITDA can be distorted by one-time cost, aggressive expensing, conservative revenue recognition. Buyer adjusts to economic EBITDA. So the buyer may normalize EBITDA post acquisition. If you answer all these three things, they understand that your concept are really clear. Coming to case study number 3, that a company decide to issue dividend worth $50. How will this decision impact the three financial statement? So rather than asking that common question, how does these three financial statement are connected, they can put this question in front of you and ask this to you. The answer is very simple. Issuing 50k dividends, income statement is unaffected. Dividend aren't expenses. Balance sheet shows 50k decrease in cash because we are paying it. And how we are paying it, we can only pay it through retained earnings. So there will be a decrease in retained earnings. So both side of balance sheet are matched. Then in cash flow, 50k outflow is there through financing activities because equity is one of our financing part of balance sheet. Then these are all written here. So before moving on, I can tell you that these are available on my website and the link is in the bio. So moving on to case study 4. Did I say bio? Sorry, it is in description. Case study 4. During due diligence, for an acquisition, commercial due diligence shows strong market growth and competitive positioning, but financial due diligence flags aggressive revenue recognition and rising working capital needs. How should an investor interpret this, and how would it impact valuation and deal structure? Again, they want to understand how will you do the due diligence. Everything is not about finance, everything is not about ratio or technicality. Something is about your mindset, how you're going to move on with that deal, and due diligence just tell you everything about it. So before moving on to what is this answer all about is, let us see what is commercial due diligence and financial due diligence. Commercial due diligence is all about understanding the market dynamics in which the target company operates. Is the market growing, shrinking, or stagnant? Who are the main competitor? What strategy are they employing? These are the questions commercial due diligence seeks to answer. Coming to financial due diligence is like giving the target company a thorough checkup. It examines the financial statement, cash flow, debt obligation, and any potential financial risk. After all, you won't want to buy a company drowning in debt, would you? Coming to the answer, how should an investor interpret this and how would it impact valuation and deal structure? So, this indicates a good business with the accounting and cash flow risk. Let me tell you how. So, commercial due diligence suggests top line story and long term growth assumption, but financial due diligence suggests you earning quality risk, potential overstatement of EBITDA, and cash conversion may be weaker than reported profits. Implication is normalize EBITDA, adjust revenue and working capital, use lower near-term cash flow in DCF, apply a high discount rate on valuation haircut, protect downside by earnouts, escrow, deferred consideration. In one line, you can say that strong commercial due diligence validates growth thesis, but weak financial due diligence required EBITDA normalization, conservative cash flow assumption, and structural protection in the deal. So, how should an investor interpret this, and how will it impact valuation in deal structure? You have answered it in just one line, and if they say how, if please explain us, the above two are very nice explanation. Coming up to our last case study and one of the main in private equity. And to see this is a dead thing, but I'm saying that this is a very important private equity question. So please do have a look out over here that a company is being acquired in an LBO with senior debt, mezzanine debt, and equity. How would the debt tranches affect risk, return, leverage capacity, and why won't the sponsor use only the cheapest debt? Have a guess what is cheapest debt and write that in comment. You will get the answer in this video only. So first, let us understand what is a senior debt, mezzanine debt, and equity. Uh, Senior debt is lender's first priority. They are like the primary mortgage holder on a house. They get paid in full before anyone else sees a cent. It's the safest position. Second, these lenders have second priority who mezzanine debt. They get whatever money is left after the senior debt is fully satisfied. It is the riskier position, so they charge a high interest rate. And lastly, equity, we all know it is ownership capital and they get paid lastly. So, how does this risk, return, and leverage capacity by tranches? The primary tranche differ based on their priority in repayment hierarchy, would directly impact their risk or cost profile. Senior net risk is lowest. It has first priority claims on asset cash flows and is typically secured by collateral. Return lowest interest rates, often floating based on benchmark like SOFR. Leverage capacity limited by strict bank regulation and maintenance convenient example maximum debt to EBITDA ratio. Coming to mezzanine debt, risk is medium to high. It is a subordinate to senior debt and often unsecured. Returns high returns because to compensate for risk, it often includes equity kickers, warrants that allows lender to participate in the company's upside. Leverage capacity fills the funding gap. Mezzanine debt is always used for funding gap only by allowing total leverage to exceed what senior lenders are willing to provide. Equity has the highest risk, repaid only after all debt obligations are met, returns highest potential return IRR. Leverage amplifies these returns because any increase in company value after fixed debt is paid accrues entirely to equity holder. Okay, so why sponsor don't use only the cheapest senior debt that we have discussed before? So while senior debt is the least expensive, a sponsor cannot fund a deal entirely with it for several reasons. Lenders limit, banks are highly regulated and conservative. They will only lend up to a certain multiple EBITDA, typically 3 to 4x, to ensure that company can survive a downturn. Secondly, repayment schedule. Senior debt often require amortization, mandatory principal repayment over 5 to 7 years, which can be extended to 10 to 15 years in some of the cases, which restrains short-term cash flows. Third, restricted convenience. Using only senior debt will subject the company to very tight financial maintenance convenience, limiting operational flexibility. Maximizing leverage. The last one. To minimize the equity check and boost IRR, sponsors need to tap into more expensive subordinated layers like mezzanine that are willing to accept higher risk and longer bullet repayment terms, paying everything back only at maturity. So we have completed this private equity case study. There were five of them, and they are very important for interview kind of prep. And if you want it on debt and valuation, do comment down. It will boost my confidence. And let's see. Thank you for watching full video. We're gonna be posting a lot of like this, so do have a check on this channel. Thank you once again.